NextGen and cloud and AI, but what we are going back to the basics or the foundations where we're talking about core systems, lending, and payments, right? So we are going to be talking about that in our panel. So I'd like to welcome my panelists now. Dom Scaffidi, Standard Advisory Panel, Bank of England, and CEO and founder, DS Payments. We have Susana Froment, Global Head, Financial and Credit Risk Type Bank. Welcome, Susana. We have some representation from a building society also. So welcome Russ, Thornton, CTO, Nottingham Building Society. And just in case you did not know, my name is Amit Jain and I'm a partner and I head IBS Intelligence. Thank you. We also had Alexi from a recognized bank who, last minute could not make it for a personal emergency. Right? So we'll miss Alexi now. So I'll start with my question to Russ. Right, with Russ. Right, we've not spoken a lot about building societies, but I think that's an important part of the economy and the financial services ecosystem. So we all know that they operate with different purpose and a different business model other than banks, right? Unlike banks. So what are the unique challenges do they face from a modernizing or transformation perspective?
Great, it's a great question, and apologies I haven't sort of updated the photo with the beard. I'll get that sorted out for next time. So I think building societies face really three main challenges, even before you get to digital plans. I think that the first is scale. We're the 8th biggest building society in the UK. We've sort of earned the right to be able to invest in our technology stack and our own sort of internal product and engineering capabilities. But if you're sort of further down inside of the sort of asset base, it's tough. You don't have the same profitability, so you really need to choose your partner ecosystem really, really well. So that view of do you build, do you buy, do you partner, all of those decisions are really quite important strategically to talk about at board and exco level. I think the second one is around people. Our customers want to speak to people, either in a branch or on a telephone. How do you create those sort of human-centered designs to be able to take advantage of digital in order to facilitate those conversations, and also inside the communities that we serve. We really have quite a lot of work that we do in terms of helping universities, helping other areas and charities inside of the cities that we're in. That's really, really important, and also for that sort of service design that we give for our colleagues. So really focusing on the people. And I think then looking at, based off of that, what is our areas of differentiation? We're a building society and we do mortgages and savings. So how do you really differentiate? How do you create lending products that let you say yes more often? So, joint couples with foreign nationals, people who may have had a bump in the road, people who may have a thin credit file. How do you use data and technology to be able to enable that lending more often to get that sort of bigger impact? And I think if you're able to address each of those three things, you've got a real chance to sort of, properly embed the purpose and the ethos of a mutual in terms of the profits don't go back to shareholders, they go back into the society. And I also think that's something the sector needs to do more about, is to sort of shout from the rooftops the importance of sort of the mutual sector inside the UK.
And also you at Nottingham Building Society have been doing some serious investments in technology recently, right? At least on the core front, right? That's what you've done.
Indeed, we've not only sort of done a full sort of transformation of the back end, our core, and we've rolled out a new broker portal with our partners MCube, so a real state-of-the-art, really interactive broker portal for onboarding of new customers, and we'll continue to innovate, especially when we start thinking about those sort of customer experiences.
Thank you so much. Susana, over to you. As we've been talking about transformation, and of course, one aspect of that is when things are becoming faster, people want it real time, or they want it as of yesterday. And I think so that also applies to lending becoming faster. And I think one of the terms that we picked up also was personalized, right? So lending is wanting to become faster and personalized, right? So how do you balance that innovation and or that fast or that speed with sound risk management, right? So from your perspective?
Yeah, and So in lending, something to set the stage. In lending, innovation happens in the end-to-end process. So it's not just underwriting, like many people think about that, but it's end-to-end. So it starts from the moment a customer is interested in getting a loan. So an application starts, or when the bank, there are some banks that have already automated their origination process, and they identify proactively a customer who is eligible for a credit. So it starts from that moment and it continues into underwriting, where the banks or the fintech companies, they run their credit risk models, they run their decisioning rules, and they output a decision on whether or not that customer, being a personal customer or a company, is eligible for a loan and can actually repay the loan. And it continues the process to monitoring and portfolio management, which requires having timely controls to ensure that the delinquency rates of that portfolio are not increasing materially, or they're increasing, as expected, as forecasted within the risk appetite set up for that specific product, and that there's an infrastructure in place to manage the loan portfolio, because it grows, to your point, it grows really fast. Lending is one of those products that, for example, small businesses, they need lending to continue operating, working capital, getting inventory. So that portfolio can grow fast, and if there are or we don't have an infrastructure in place in a strong loan management system, in a strong analytics, and a strong dashboard, and a strong credit team monitoring the performance of that portfolio, it can result into material losses affecting liquidity and capital of the financial institutions. Then we continue the process to collections. So collections is very important for recovering that liquidity that has been, or capital that has been allocated, to fund those loans. So collections also needs controls to ensure that the collections strategies are picking up the right customers. For example, there are high-risk collection strategies, medium risk, low risk collection strategies, and sometimes they are not efficient. They are not delivering the results that we need. And so ongoing monitoring to address those strategies, and the methodology as well to collect that money needs to be monitored. And we finalize the end-to-end process with the write-off, because sometimes it goes that way. You cannot collect the money, you have to write it off. So it needs to be accounted for properly, and ensure that write-off does not materially impact the capital of that financial institution. So having said that, it's an end-to-end process, right? So innovation can come from different levers within the end-to-end process. And for example, when in our case we have automated decisioning engine, so the end-to-end process is fully automated. And how do we manage the risk? Going back to that point, we before deploying any innovations in new segments, new credit rules, new channels, or new automated for collections, for example, we answer this question: will the new product, new rule, new feature be safe? Is it risk compliant? And how do we assess that? Is by running a product or feature risk assessment before the feature is deployed, right? So it's a comprehensive assessment of conduct risk, not just credit risk, but conduct risk, related to collections, legal risk, do we have the correct contracts in place, and fit for purpose, is the product fit for purpose, etc., etc. Then we move to how are we going to ensure that we are managing well the capital that we have, and financial institutions have, to test that innovation. Because in a small business segment, for example, things can go wrong very quickly, right? It's a higher risk segment.
Yeah.
So we have a structure of test and learn, and we set a certain budget to manage that, to test the performance of the new feature, the new product, the new segment, and monitor the performance and have guardrails to pass to to release more funds. And finally, we ask ourselves the question how we're going to monitor all this, because we got to make sure that it's risk compliant. Then we make sure that we have money, and then we have to monitor and manage it, right? Exactly. So we set key risk indicators to monitor the delinquency rates of that product, SLAs, incidents related to the full end-to-end automation that we have done. We set risk appetite to ensure that the product is within our profitability targets and delinquency targets. And finally, we have a governance structure where we have a credit risk. I share the credit risk working group, for example, and we have representative of credit, collections, finance, operations, and executives to discuss the performance of the new innovations in the old portfolio as well, the traditional portfolio, and we come up with the solutions. If, for example, if a KRI is not met, and also we decide whether or not a new segment or a new innovation. For example, if we have expanded our lending to a riskier segment, if we retire that segment because it's not meeting with our risk appetite.
No, thank you so much for that comprehensive answer. Going to Dom, as just like lending, I think payments is becoming faster. It's also becoming more real time, invisible. So where will banks now? I think payments are becoming commodities, right? Are becoming commoditized. So where do banks want to make the differentiation from a payments perspective?
Yeah, first of all, I'm surprised. I thought the process was easier, so you just call and get the money. No, it's not like that. Anyway, so answering your question, and also this lunchtime. Yes, real-time payments are becoming the normality everywhere in the world right now, and this is mandatory or decision on the bank side, but it's everywhere. The consumer is waiting for fast payments that are, of course, frictionless, that are embedded, and that are working. And I don't think that we see consumers that are switching bank because they settle in 3 seconds instead of 5 seconds. They are just fast, okay? So what is the differentiator? So the differentiator is the fraud detection. We are talking about cash forecast, liquidity optimization, and then automatic settlement. And sorry to say, because I know that you don't want to use this word, but artificial intelligence inside driven, because finally is a part of the elements. But I'm not explaining anything, just mentioning.
Sure.
So if we see the point from the financial institution as a perspective, the battleground is where the financial institution is able to orchestrate real-time rails, RTGS systems, and stablecoin for the settlement layer, because it is where we are going right now, and card scheme as well. And all of this is going to be the differentiator. It is where banks are going. And the reason, just one, is not really making payment fast, because it's already there, but helping the consumer, the customer, to make the right decision with its own money. It is where the differentiator is.
So I think thank you so much, Dom, for that perspective. Right, I know we're running out of time, But I do want to do a rapid fire, literally called it a rapid fire round, and to all of us, I think, starting with Dome, right? Going back to our topic on across core banking, lending, and payments, if you had to place one bold bet on transformation that'll define banking in the next 10, 15 years, what would that be and why?
Yeah. It's a convergence of real time and of course the driven of the liquidity management. So we have, I know that you are going to punish me, but it's AI that is going to decide, real-time payments is going to execute, and then finally we have the optimization of the liquidity that is going to make the difference. So in other words, what we have is a better use of the liquidity in terms of the availability.
It promised me that you're not going to do that, but
Susana.
Susana?
Yeah, I agree. I think data availability, and have not just the data being available, but also clean data will make a huge difference. And the companies which are able to use that data to better identify the customers on an automated way, on a real-time way, using real-time information will be in optimizing the identification of the probability of default will be the winners. And I have to use that word, but also I think those companies, lenders who can actually use AI agents to monitor the portfolios will be winners because of efficiency.
I'll come at it from a technical perspective. I think for the last decade, we've been busy writing microservices that sort of decouple the backends, etc. I think in the next 4 or 5 years, microservices will go away. There'll be a series of agents with agentic networks that will deliver a lot of that real-time ability as a positive thing, but as a negative thing, your ecosystem will expand massively. You may not even know who your agents are actually speaking to at that point. So I think there's going to be a real upside in terms of the ability to continue to decouple the back end, to use faster payments or payments in real time, to be able to use that data, but it's going to come at a cost and a challenge.
Sure. No, I think thank you so much for the panel and for your rapid fire without using the word AI. I think I want to take this opportunity to thank my fellow panelists for this rapid fire sort of panel that we had. Thank you so much, Dome, Susana, and Russ, and hope you guys found this useful. Thank you.
Sorry.